That sounds great. Well, so far, very impressed with the spotlights, the keynotes. So thank you, Martha, and the team for organizing all of this.
Absolutely, absolutely. I appreciate you making time and joining us from the West Coast.
Yes, my pleasure. My pleasure.
So, Brian, as we kick things off a little bit, and while we're working on making sure that Steve is able to be connected, talk to me a little bit and share a little bit of your perspective and background in helping companies go public and guiding them when they are public, because you are the head legal guy at a very large public company that has quite a market presence.
Absolutely. Happy to help. And I just want to start by thanking you again. And also just to say that, the views that I'm expressing today are, my personal views, don't necessarily reflect those of my employer, nor of the SEC Advisory Committee on which I sit. I think with respect to Upwork, our 2018 IPO provided us, 5 primary benefits. Certainly a long, arduous process to get there. But for us, it really served as a branding event, which I believe continues to give us more credibility, prestige with customers of all sizes. I think secondly, as a company that had been formed 15 years before the IPO, and because we generally restricted stock transfers in the secondary market for a good 5 years before the IPO, going public did provide liquidity access for existing investors and employees. I think third, the IPO gave us the optionality more than anything else to more readily use our publicly traded stock if we wanted to do a stock acquisition, for example, employee retention. It also gave us the ability, for example, to handpick, what we thought were going to be buy and hold institutional investors who we wanted to receive the newly issued shares. I will say that looking back now, a number of them were much more short-term focused than we had anticipated. So I will say one of the biggest disappointments for me thus far. And then lastly, even though we didn't need to go public to raise capital, the IPO also opens up the public capital markets for additional financing, capital raising, and it also results in just higher valuations, I think, because there's no longer the illiquidity discount that's associated with the private market. And my sense is that this year's public convertible debt market has seen much better pricing for issuers than a private debt market would be priced. And just sort of lastly, in connection with our IPO process, I do think the Commission's efforts to facilitate IPOs over the past several years helped us on several fronts. First, it enabled us to, conduct useful non-deal roadshows, testing the waters meetings, to get our name out there, to tell our story, and frankly, refine our messaging before the formal roadshow. Second, the initial S1 confidential filing was helpful. And lastly, the SEC comment letter process seemed more focused on substantive issues as opposed to what I view as more nitty form items that I had seen in my prior IPO experiences. So that's a flavor, of sort of the pros of going public. And I don't know if that's helpful.
So, Brian, question for you as you're thinking about, you've got your experience going public, and I have a feeling that being right in the heart of the Valley, you've got a lot of folks that reach out to you and say, okay, we're thinking about it, but we're trying to weigh different things. What are you hearing people talk about right now as they're looking at kind of changed economic environments? I mean, I know that we have COVID-19, people aren't traveling. There's a lot that's been said about what's happening with roadshows. And we've got Steve here. Steve, welcome. I see your video. Glad that you're here. Just curious what you're thinking about kind of the evolution of roadshows and how you go about marketing pre-IPO to investors, if that's something that you're hearing people talk about.
Martha, I'm assuming that was a question for Brian.
It is a question for whoever of the two of you would like to answer it, Steve.
Well, I just parachuted into cyberspace. I'm catching up.
Electromagnetic interest is always impactful, Steve. We're glad to have you.
Okay, it sounded to me like I dropped in when Brian was talking about the advantages of going public.
Yes.
So you had a question, Martha, and I'll jump in and talk about the disadvantages as soon as you finish.
Yeah, as far as what companies are doing now, I really don't have a sense, Martha. I think the investment banks and the other, the big law firms may have a better sense just because they're more repeat players in the space. But I do think it's, with the benefits come the disadvantages, and we certainly are facing some of those now. But that might be a good segue into Stephen sort of giving his sense of some of the negatives of being public or thinking about going public.
Sure. Let me just kind of jump into that. Everyone hears about costs, and more costs, and certainly it is a very expensive and time-consuming process, as well as an expensive and time-consuming existence. You will need a team of lawyers and accountants to assist with the drafting of the registration statement and getting it through the SEC. You'll need increased infrastructure in terms of financial and legal personnel to handle finances, communicate with the street, and deal with periodic reporting requirements, listing fees or other consulting fees. And by the time all is said and done, the TAP for going public typically is in the range of $2.5 to $4 million. And of course, investment bankers are there to earn a fee ranging between 4 to 7% of the gross proceeds. And certain of the costs incurred in the run-up to an IPO will, of course, be permanent. The enhanced infrastructure is not going anywhere. There is the cost associated with ongoing statutory and regulatory compliance, your 10K, your 10Qs, the occasional 8K, your proxy statement, your annual meeting. There's a quarterly earnings release, establishing and complying with public company policies such as the insider trading policy, and dealing with the things that will come along in what may seem to be an endless flow. For example, wrestling with disclosure issues and Regulation FD, and addressing disgruntled shareholders. The annual cost of all of that is between $1 and $2 million, and those are just the hard dollar costs. In addition to the hard dollar costs, you need to understand that your life will no longer be your own. There will be increased investor scrutiny. You will have the street and your public shareholders to be responsive to. Disclosure requirements may force public disclosure of information that you would rather not ever disclose, or at least not yet, such as the key metrics of your business. You become more of an open book to your competitors. Executive compensation, security breaches, executive and board changes, unsuccessful business ventures, etc. There is also, of course, the potential for stock price volatility to have an adverse effect on employee morale, not to mention generating shareholder suits. And so you can add greater exposure to litigation and the activist shareholders to the list. And finally, there is the potential for employee turnover when they suddenly have access to liquidity. When their stock options might begin to mean something. But notwithstanding all of that, you decide to go public anyway. And in that case, you'll be spending a lot of time drafting disclosure. The reporting regime does provide for some areas of scaled disclosure for small companies. And I was going to flip it back to Brian and ask what are some of the areas that where you think it makes sense to scale, and do you view any of these requirements as kind of out of whack in terms of driving shareholder value?
Yeah, thanks for that, Stephen. I definitely have, I think, two observations here. First, I think the compensation disclosure for issuers other than smaller reporting companies and emerging growth companies is burdensome and expensive. And I don't get the sense that the streamlined disclosure requirements for these SRCs and EGCs is depriving investors of meaningful information. And second, while auditor attestation of internal controls is important, it does seem like there's an opportunity for a longer phase-in period following a company's IPO, even if the issuer will otherwise qualify as an accelerated or large accelerated filer. We had to comply with SOX 404B attestation in only our second 10K after going public because the company qualified as a large accelerated filer and was no longer an EGC. And that transition was very expensive, required a ton of internal effort, especially on the heels of the very time-consuming and expensive IPO process, Steve, as you just referred to. I should note that the SEC has made good progress here, having already changed the definition of a smaller reporting company and allowing smaller companies to avoid the attestation requirement. I just think there may be more opportunity to tailor the requirements on this front. And with that, Stephen, do you have any thoughts on quarterly reporting and sort of a sense of short-termism versus long-termism, for example?
Good point. Quarterly reporting is important, and I think it generally works well. I think there's some things around the edges that I think might be useful. There is the potential for more streamlining. For example, sometimes your risk factors manage to sneak into your queue as well, and I'm of the view that 40 or 50 pages of risk factors doesn't do anybody any good. Let's figure out some kind of way to deal with that. I know that a lot of it is based in fear. If my competitors put that risk factor in, then I better put it in too. And if one paragraph is good, then 3 paragraphs has got to be even better. But as far as things that that we might be thinking about, one is just note that foreign private issuers are not required to do quarterly reporting. If they are not required to do reporting, then why shouldn't domestic issuers, have be extended the same courtesy? And sometimes I wonder to what extent investors really care about 10Qs in any event. Stock price changes tend to be driven by earnings releases and calls, and not by quarterly disclosures in a 10Q.
Yeah, I agree.
But it can be hard for companies to resist managing to quarterly results instead of managing to long-term business strategy. I have always been of the view that you should do what is best for the business long-term and not be driven by the quarterly earnings call. I've never thought that the market made me do it was a very good defense. Mm-hmm. You have a strategy, you have a vision. Make sure you are understood by the street, and investors can invest in your company or not, based on that vision, not the near-term stock price. It's sometimes easier said than done, but you're running the business, not some outsider. And on the subject of doing what you think is best for the business and not bowing to outside forces, that brings to mind proxy advisory firms. And Brian, I just thought I might get your thoughts on these firms and related to that, what you might think of the shareholder proposal regime.
No, thanks for asking, Steve. First addressing the shareholder proposal, I do think it's currently far too easy to bring a shareholder proposal. I'm certainly very supportive of the SEC's proposed 14A8 amendments to increase the $2,000 minimum ownership threshold that's required now is just far too low, and I'm not sure that's changed in decades. I also do believe that the proxy advisory firms review governance per se in a black box and do so pretty formulaically. I think the current system doesn't account for the company's results, its stage of development, because the governance of a newly public company should look very different than a mature company, nor do I think it accounts for the company's voluntary governance improvements over time. And all this sort of tied together with the fact that large passive investment funds or the index funds have essentially handed over their voting rights to the proxy advisors. The proxy advisory firms wield a ton of power these days. So when combined with the current shareholder proposal regime, companies are being forced to make governance changes that aren't necessarily in the interest of the company, but rather the small activist stockholders. And I get the sense that large investors aren't affirmatively driving many governance changes, but rather they're voting for them after much smaller stockholders put them on the ballot and are almost unanimously supported by the proxy advisory firm. So this is a frustrating environment for a company such as ours, which has been public for less than 2 years, has customary protections for a young public company, and where there is solid stockholder representation on our board, because we have several board members who hold sizable equity stakes in the company. So just some thoughts there. Maybe a little bit of segue. Stephen, you see a lot of firms out there. Are there any, types of companies, sectors of companies you see in the current marketplace who want to go public? Those who want to stay private. Give me a sense of, the profile of a company you would recommend they go public or not go public if you can.
Well, good question. Yeah, and usually when these kinds of questions come up, it's the there's so many people that are just kind of ignorant, I guess, to the process, which is not surprising. This is not their life, but they have a company and their dream is to go public, whatever that means. But it sounds good and kind of establishes your brand, and suddenly you get all this liquidity and everything else, which as we well know, if you're not really qualified to go public and you manage to drive the process to get somebody to kind of help you get public when before you're ready, all those benefits that you thought you might realize, you don't receive, and all the disadvantages you do receive. So so care needs to be used in that regard. I would think that at the top of the list would be having a model and the ability to attract analyst coverage. Personnel, you need a complete management team, IR team, legal team. Your financials need to be complete, transparent, showing trends that are expected for the particular industry. The financial statements must have been previously audited by a top accounting firm to reduce the likelihood of any accounting. Tech has been leading the way, and in that sector, an ideal profile is high revenue growth, and that would be in the defined as 30% plus. I think part of the question is who wants to go public and who doesn't, and again, the real question is, there are plenty of companies across sectors who want to go public, and the real question is, do you meet the criteria? You have an unattractive story and unattractive financials, management not ready, and just the opposite of the list that I just provided. And then I suppose there are those companies that do qualify but don't want to, and sometimes get forced to anyway because of the liquidity that is demanded by their employees and by their investors.
I think, Steve, one thing you've made very clear, there's a lot of variables that need to be considered as you're weighing the decision to go public and what you're looking at, whether it is driven by liquidity or by need to tap the market for repeat access to capital. But I just want to say thank you to both of you for sharing your perspectives. We're coming up on time, and I'm the taskmaster that's keeping us on a schedule today. So I'm going to, unfortunately, have to wrap this, but you've teed up a number of topics that will be very insightful for our 4 p.m. Eastern session.